Hi, and welcome to Young Kids Got on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this episode, we're back for some more on hedge accounting, fair value hedging in this case. And for more on hedge accounting and risk management in general, please consult my book, Corporate Foreign Exchange Risk Management. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So just to recap very quickly, hedge accounting is a way to account for derivatives, which is then different from the way you're normally supposed to do it, which is fair value accounting. The problem that motivates hedge accounting is that fair value accounting applies to derivatives, but not the business transaction they are meant to hedge. So a mismatch arises that creates more volatility in net income. So you have to report any change in the market value of a derivative as a gain or loss in net income. So there's more noise coming from these unrealized gains and losses. Whereas hedge accounting then allows you to take these unrealized gains and losses out of net income and therefore stabilizing it. So that is what hedge accounting accomplishes for you. So normally business transaction is what corporates hedge, and that is the sort of main concern, that this type of mismatch between the accounting of the business transaction and the derivative. However, it's not the only purpose of hedging that you'll find out there. Sometimes we would like to use hedging to protect the value of certain assets or liabilities. So as opposed to transactions then. So if protecting the value of assets and liabilities from market risk is the goal, we're going to refer that to that as fair value hedging. Which, just to differentiate between the two, you have cash flow hedging then being about protecting cash flows related to business transaction from the impact of market risk. Fair value hedging is instead when the hedging strategy is about protecting the value of specific assets and liabilities from market risk. And cash flow hedging is described in one of my previous videos, so please learn more about that there. We're going to discuss fair value hedge accounting in the rest of this video. So by applying hedge accounting as it relates to fair value hedging, then usually the goal is to protect ultimately the firm's equity from unrealized gains and losses created by these derivatives. Equity being the difference between assets and liabilities. So ultimately, any volatility will end up affecting equity, right? So we can protect equity from this market risk. We will, however, find that most of the times we're simultaneously stabilizing net income. So it's not like they're in opposition to each other always. Rather, they tend to be, both tend to be stabilized at the same time, as we're about to see. So when you're talking assets and liabilities, that could be any type of asset liability, as long as it's not already fair value accounted, because then a match would tend to happen already, so we're talking about some asset liability that is not fair value accounted. So that could be a fixed rate loan or an inventory in some companies, right? So what you would try to do if you design a hedging strategy with this purpose is to make sure that the fair value changes of the hedge, the derivative, move in the opposite direction of the fair value change in the asset or liability. So that is the hedging part of this, right? They will offset or cancel out. So for example, if you're hedging to protect the value of inventory and the inventory goes down, a well-executed hedge will see, the derivative will see its value go up, producing an offsetting effect, right? So we have the basic problem here that the derivative is mark to market always. The assets and liability being hedged is not mark to market. So you get, as a result, more volatility in net income, which is contrary to the goal of the hedging strategy, right? So hedge accounting allows us to restore that matching principle and take out this volatility. So an example here, a German firm issues a bond in British pounds in March. At the time, the exchange rate is 160, meaning it's a liability to the tune of 40 million euros in home currency terms. So for whatever reason, this company has decided to enter a swap, whereby they will now receive a fixed cash flow in British pounds corresponding to the coupons of the bonds. It's the fixed rate leg of the swap, right? Instead, they're paying a variable rate, which is reset frequently, right? And that's the floating rate leg of the swap. So they've transformed fixed rate liability here now into an exposure to the short-term interest rate instead. So by the next quarter's end, we have interest rates have come down, and bad news for the bond, because the value of this liability is a fixed rate liability, right? So when interest rates go down, this liability will go up. So we're going to assume it's now 45 million euro, as opposed to 40 earlier. For the swap, but because it's been designed to hedge the bond, right, you have a mirroring 5 million gain. Its value increases for exactly the same reasons, right? So because you're receiving the higher fixed rates and you're paying the lower floating rate. So that's attractive, right? So it becomes an asset and you have a hedging effect. So economically, this is a functioning hedge. The effect on the swap takes out the effect of the bond, and your value is unaffected by market risk. However, due to the way these things are accounted for, the gain on the swap will go into net income. So it's a derivative, and the rule is fair value accounting, unless you would do something about it, right? The bond, however, in our example, is not fair value accounted. So the gain on that, it should be a loss. The loss on that does not enter net income. So it's an economic hedge that makes sense. It works. However, the accounting mismatch is there, so you will get more volatility. And just to restate the goal here of hedge accounting is to address this problem and remove this artificial volatility from net income. But interestingly, the matching is achieved not by taking the swap gain or loss out of net income as you might expect. So in cash flow hedging, you would redirect the gain or loss to another statement of income, the other comprehensive income, thereby not having to show it in net income. Not so here. Instead, the mechanism is to account for the bond as if it were fair value accounting. So we're going to use a number of accounts here: assets, liabilities, equity, net income, other comprehensive income, and cash flow statements. So we have this self-contained example here. So we're just going to see how this plays out when we apply hedge accounting versus the base case. So first, let's have a look at the case of no hedge accounting of the swap. So what goes on here is that initially you raise 40 million through a bond issue. The derivative you enter simultaneously does not, it's neither a gain or loss at inception, right? You enter it on fair terms. In the next quarter, as you're about to close the books, you will find that, the value of the swap is now 5. It goes from 0 to 5 because the interest rates have come down. So that yields, this revaluation, market to market, the derivative yields an unrealized gain, a fair value gain on this swap, which ends up pushing up retained earnings as well, through the standard mechanism. What's worth noticing here is that the value of the bond remains unchanged. So you have, as a result, more volatility. It is not fair value accounted, and therefore you get this mismatch. And the hedging of the bond, which is economically sensible, ends up creating more volatility in the accounts. If you instead apply hedge accounting, what changes is that you're now allowed to report the bond, the fair value on fair value terms. So it goes from 40 to 45, creating a loss, and this loss is 5. So it exactly cancels out the 5 million gain here on the swap. So there's now no volatility in net income nor equity. And we have achieved the goal, basically, which was to keep a nice and tidy net income and equity. So we don't have to be bothered by these interim effects from fair value accounting. And we can concentrate on the fact that, economically speaking, we're fine now. We accomplished the goal without any side effects in terms of a more turbulent set of financials. So the matching principle is restored. There's less volatility in net income and equity. Please pay attention to that. So, right. So to summarize, the purpose of hedging is sometimes to protect the fair value of an asset liability from market risk, as opposed to business transactions, which is more common, but still. Differences in accounting, fair value accounting for the derivative and the swap in this case, compared to no hedge accounting for the hedged item, leads to a mismatch and more volatility in financials. And you can address that and avoid it by applying hedge accounting. So by applying hedge accounting, you get less volatility in the financials, and because the matching principles is restored, and we can rejoice in the fact that we have a well-functioning economic hedge without any side effects in terms of volatility in financials. All right. For more, please consult one of my books. Have a good day. Bye.